You had steady revenue, a strong investor sentiment, and a pretty diversified business mix that kept Tata Consumer Products Limited on a solid trajectory. Now, after March last year, that's 2024, with FY 2025 popping up, that picture changed. Now, suddenly, TCPL had margin pressures, they had rising input costs, and with volatility in commodity prices, you had a spanner in the works of this fairly smooth narrative. So, is this a hiccup in an otherwise promising story, or is it a sign of something much deeper? Welcome to Bottomline by Groww. In today's episode, we'll be diving deep into Tata Consumer Products' business structure, their financials, the associated risks, and their future growth potential. Now, Tata Consumer Products Limited has been a part of the Tata Group and a regular feature in Indian kitchens and also a rising player on global shelves. Now, they were formed in 2020 through a merger of Tata Global Beverages, that is TGB, and the consumer business of Tata Chemicals. And since then, they have built out a fairly impressive and diversified FMCG portfolio. They have a strong focus on beverages, food staples, and a whole lot of health-oriented packaged foods. Now, today, they are amongst the world's biggest tea companies and they have a solid presence in about 40 countries. However you look at it, right? Whether it's Tata Tea brewing in your home or Tetley in cups of UK and Canada, their product portfolio is connecting geographies and generations. Now, FY25 was a milestone year for them. Their company posted a 16% year-on-year revenue growth, and their India Foods segment led that charge. That grew 29% year-on-year, and all this came on the back of a 30% jump in Tata Sampann and a steady growth in the Tata Salt segment. There was even a 21% YOY jump in non-branded business on the back of strong growth in solubles and plantations. Now, TGP's growth strategy really is supported on the back of acute joint ventures. You have Tata Starbucks, which is a 50-50 JV with Starbucks Coffee Company, and they're aggressively planning to scale from 400 stores now to about 1,000 stores by 2028. You also have the Amalgamated Plantations Private Limited, APPL, and that plays a big role in the company's plantations-linked operations, especially in the tea space. If you dive deeper into TCPL, you'll notice that they have become leaner and efficient over the years. When you look at the cash flow to EBITDA ratio, which is their ability to generate cash from operations, their cash conversion cycles have halved over 2 years, and the operating cash flow to EBITDA ratio has improved to 101% in FY25, and that's coming from really 92% in FY20, and that's a solid sign of better working capital management and stronger cash generation. But really, all this growth wasn't without a hiccup in Q4 FY25, and for full FY25, EBITDA margins dipped. This was on the account of higher input costs, especially from the tea and the coffee inflation, and increased amortization from past acquisitions. For Q4 FY25, the margin declined from 16% in the same period last year to 13.6%. Similarly, for FY25, the margins fell from 12.8% last year to 10.8%. As a result, profit after tax, that PAT, those margins also slipped. Still, you've got strong brand equity, expanding product lines, and improving operational metrics. They're fairly well positioned to grow both in your kitchen and your portfolio. So that brings us to what's next for Tata Consumer. Now, the company seems to be moving towards stable growth trajectory in the coming years, and there are a couple of things that you really should watch out for. Now, stepping into FY26, the outlook remains broadly positive, but there are a couple of challenges on the radar that you should keep in mind. To begin with, the company isn't looking at any major capital expenditure or capex this year, and the management has said that that spending is going to be in line with the past trend. What that means is that they're focusing on operational efficiency and really disciplined growth. There are also several encouraging signs to support there. Now, tea prices, which have been squeezing margins in the past, have started to stabilize, and price hikes in tea and salt are now beginning to reflect positively on their profitability. Now, adding to that optimism, there are reports that the March-April harvest of tea this year has been a better crop, which is, well, good news for the India beverages business, but you kind of need to keep an eye out on how the monsoons are going to impact over the next few quarters as well. From a distribution standpoint, the company's modern trade channel grew 18% YOY in FY25, and in Q4 FY25, they were up 26%. The e-commerce revenues shot up 57% YOY in FY25 and 66% in the March quarter, and that highlights both strong execution in both offline and digital strategies. They're also innovating very strongly. TCP launched 41 new products in FY25, which really pushes the innovation to sales ratio in India to 5.2%, even on a growing revenue base. And that's a 6-fold increase since FY20. Their India growth businesses are also gaining solid momentum. Tata Sampann reported 29% for the full year, while Tata Soulfull grew 32%, which comes on the back of rising demand for millet and health-oriented products. There's macro tailwind as well. Now, the government's proposed import tariffs could give India-based FMCG manufacturers like Tata Consumer a competitive edge. although the full impact of that remains to be seen. Financially, one of the most promising developments for Tata Consumer is their plan to pay down debt taken during past acquisition, and this could meaningfully reduce interest costs and further strengthen their financial position. That said, it's not going to be exactly a smooth ride for Tata Consumer Products. There are a few risks that investors should watch out for. Now, coffee prices are expected to remain elevated, driven by poor harvests in the Arabica seeds from Brazil and the Robusta lot coming out of Vietnam, and this could continue to put pressure margins on the international coffee portfolio. And there's Tata Starbucks, their very high visibility JV business. While they have a plan to expand from 400 stores to 1,000 stores by 2028, they have flagged a major constraint, and that's the availability of quality real estate. Now, finding the right location at viable cost is proving to be a hurdle, and any delays or missteps there could impact the company's cafe segment growth. What's the big takeaway from this steady FMCG company? Now, Tata Consumer is entering this fiscal year with strong brand momentum, improving cash flows, and a healthy product innovation. But as always, you need to balance these growth ambitions with margin stability, especially at a time when there's volatility and execution risk in key ventures like Tata Starbucks, and that balancing act really will be crucial to maintaining investor confidence. So, what do you think about this FMCG company? Leave us your thoughts as comments. And for more insights, subscribe to Bottomline by Groww.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.